If you own French bank stocks, European financial ETFs, or even certain European government bonds, you need to hear this. There is a €600 billion risk hidden in plain sight, sitting directly on the balance sheets of France's largest banks. It's not buried in footnotes or offshore accounts. And this isn't a prediction. It's a balance sheet reality documented in regulatory filings that most investors simply are not reading. What makes this so concerning is the structure. These risks are interconnected in a way that creates a direct path for financial stress to spread from one bank through the entire French banking system and straight into European government debt markets. The triggers for this stress aren't hypothetical. They are happening right now. Let me show you exactly what the documents say. France's three most important banks, BNP Paribas, Société Générale, and Crédit Agricole, collectively hold €600 billion in derivatives exposure. That's according to their own 2024 annual reports filed with the European Banking Authority. This is the gross notional value. Even after accounting for netting agreements that reduce some of the risk, the net exposure is still a staggering €180 billion. To put that number into perspective, France's entire GDP is €2.8 trillion. This means the net derivatives risk held by just three banks is equal to about 6.4% of the entire French economy. So where is the vulnerability? It's in the specific types of derivatives they hold. The portfolios are heavily concentrated in three areas: interest rate swaps, credit default swaps on European government debt, and cross-currency swaps tied to the euro-dollar funding market. Each of these is currently experiencing a level of volatility that the bank's stress tests from just a few years ago never anticipated. Let's start with interest rates. The European Central Bank has hiked rates from negative 0.5% in 2022 to 3.5% today. That 425 basis point jump is the fastest rate hiking cycle in the ECB's history. Every single basis point movement reprices billions of euros in these interest rate swap portfolios. Now, French banks are generally structured to benefit when rates rise. The problem isn't the direction, it's the speed. The rapid increase puts immense pressure on their counterparties, the ones who are paying the higher rates. When those counterparties start facing liquidity problems, they can't post the required collateral. This leads to collateral disputes, and history shows that these disputes can quickly escalate into systemic financial events. The immediate danger isn't a credit loss, it's a liquidity and capital crisis driven by margin calls. Next, let's look at the credit default swaps, or CDS. Think of these as insurance policies on debt. European regulators' data shows French banks hold about €85 billion in CDS contracts on European government debt. They are heavily exposed to the debt of Italy, Spain, and Greece. Over the past few years, the perceived risk of these countries has been rising. The yield on Italian 10-year bonds has widened significantly over the safer German bonds. Spanish and Greek debt spreads have also moved up. When these spreads widen, it means the cost of insuring that debt goes up. French banks, which often sell this insurance to earn premium income, suddenly face mark-to-market losses. This directly impacts their capital reserves under the Basel III banking regulations. So why should this matter to your portfolio right now? The market is already showing signs of concern. French bank stocks are trading at about 0.6 times their tangible book value, meaning the market values them at only 60% of their stated worth. This signals deep-seated worries about their assets and capital. Despite this, many retail investors and passive funds continue to pour money into these banks simply because they are part of major European banking ETFs and indices. The final piece of this puzzle, and perhaps the most complex, is the cross-currency swap market. French banks are major players in the massive euro-dollar funding flows. They help European companies and governments that need to borrow in US dollars. The cost of swapping euros for dollars has widened dramatically, making it much more expensive for anyone who borrowed in dollars to repay their debts in euros. As intermediaries, French banks face risks on their existing swaps and a huge rollover risk when these contracts expire and need to be renewed at much worse rates. The Bank for International Settlements even flagged this exact risk in late 2023, noting European banks have about $2.3 trillion in assets funded this way, with French banks accounting for nearly a third of that exposure. So I want you to answer this question honestly, because it determines if this risk is your risk. What percentage of your stock portfolio is in European financials? What percentage of your bond portfolio is in French bank debt or covered bonds? Go check your holdings right now. The data suggests that for most investors, the answer is not zero. Many hold this exposure without even realizing it through broad European ETFs. You might look at French banks and see what looks like a healthy capital position. Their core equity ratios are around 13%, well above the 10.5% regulatory minimum. But dig a little deeper and a more troubling picture emerges. The real story isn't in the headline numbers. It's buried in the complex world of derivatives and sovereign debt. The way banks calculate risk is key. Under current rules, their massive derivatives exposures get a favorable risk weighting. This assumes their trading partners are rock solid and their risk hedging models are perfect. But what if they're not? What if a major counterparty gets into trouble, like Lehman Brothers did in 2008? Suddenly, those assumptions crumble and the real capital needed can skyrocket. Recent stress tests by the European Banking Authority gave us a glimpse of this. In their adverse scenario, French banks' capital ratios dropped to just 9.8%, dangerously close to the minimum. Here's the kicker. Some market indicators have already blown past the levels used in that adverse test. This means French banks are already operating in conditions that the regulators considered a worst-case scenario. They're sailing much closer to the wind than anyone is admitting. Then there's the doom loop between banks and their own government. French banks hold about 240 billion euros in French government bonds. When political uncertainty or economic worries cause the value of those bonds to fall, the banks' balance sheets take a direct hit. This creates a vicious cycle. Weaker banks lend less, which slows the economy. A slower economy makes it harder for the government to manage its debt, which further spooks investors and hurts the value of those bonds held by the banks. We saw this exact dynamic play out during the European debt crisis a decade ago. The risk doesn't stop at the French border. French banks have massive lending exposure to other European countries, including 180 billion euros to Italy alone. If a crisis starts in Italy or Spain, French banks will be on the front line. And how are these banks funded? A huge chunk, about 35%, comes from short-term borrowing markets that can freeze up in a heartbeat. Remember the US regional banking crisis in 2023? Even though European banks weren't directly involved, their borrowing costs shot up simply because of a loss of confidence. For French banks, with their heavy reliance on these markets, a similar confidence shock could be devastating. The market is already sending warning signals if you know where to look. The cost to insure against a French bank defaulting has nearly doubled since early 2023, and their stock prices have consistently lagged behind their European peers. The credit markets are quietly repricing this risk long before it hits the mainstream headlines. So, what does this mean for your portfolio? It's time to ask some tough questions. First, how much exposure do you have to European financials? It might be time to rebalance. Second, have you stress tested your bond holdings for a scenario where French bond values fall further? And third, do you know what your money market funds are holding? Many are packed with French bank debt. The risk is that a 600 billion euro derivatives book, combined with these other pressures, creates a vulnerability that current market prices are simply not reflecting. The real question is, will your portfolio be ready when the market finally wakes up? I've put together a detailed analysis that breaks all of this down, with specific data, stress scenarios, and hedging strategies. You can access it through the link in the description. Subscribe for more deep dives into the financial risks that others miss. And let me know in the comments, do you think investors are being properly paid for the risks in European banking right now? Thanks for watching.